Hello and welcome to episode 511 of the Money to the Masses podcast with your resident expert as always, Damien Fay, and me, Andy Leeks. Damien, welcome back. How are you doing?
I'm in buoyant mood, Andy, actually. On our social channels, we always mention at the end of the show about socials, so I'm wanting to do it a bit earlier in the show. Please do follow us on all our socials. And what's been great is some of the bits we've been taking from the podcast and turning into videos. So the recent pieces that we've done on premium bonds, growing your wealth, or where you actually stack up, and why the first 100k is important, have done very well on YouTube and attracting more and more followers and subscribers. So please, if you listen to the show, do go over there and subscribe to the channel, because we do put out other content, not just clips from the podcast and all of those. We're always doing new content on all of our channels, and on Threads, for example, there's a lot of written content that I do and explain things, quizzes. So do go over there. But I'm really buoyant about how well that's doing now. So hopefully there are a whole bunch of people who are on YouTube and Spotify who are listening, watching this for the first time. So if that is you, then welcome to the show. Now I'm going to lead on with what's going to be on the show this week, because there's quite a nice link to that, actually. So the last few pieces that we've done that have been incredibly popular have been crunching numbers around certain topics. And we're going to do one today, and it's renting versus buying. So when does renting work out better than buying a property, or when does buying a property work out better than renting if you are a first-time buyer? It's a question that we're often asked, and there's been lots on social media that I've seen that are trying to suggest things like renting is definitely better, and people have been led to believe that buying a property is the best thing to do, but it's all been a grand lie. So what I want to do is dispel some of the myths around buying a property, but also to show you some of the details and the nuances of how it works. There's a lot of factors that go into the finances and the numbers of whether renting is better than property and vice versa. The second piece on the podcast I'm going to be looking at is how to make money from a credit card. There are two main ways to do it. And the final piece of the show is going to be in relation to a scam.
Yeah, so I'm going to be talking about a sophisticated scam that has already cost unsuspecting holiday makers hundreds of thousands of pounds. So I'll break down exactly how that scam works, what to look out for, and the things you can do in order to protect yourself. And the reason I say that is because there's a specific company that's been impacted by this. I'll share that at the end of the show.
And the reason you really need to listen to Andy's piece at the end of the show is because I was targeted by this very scam earlier in the week. I'll say it was me, it was actually my wife. And it's just coincidence that Andy suggested this as part of the podcast this week, just about the same time when I told him about the story that had impacted my finances.
Okay, so let's get on with that first piece of the podcast then. Damien, you've had a very busy week getting into the numbers. You said last week you're a mathematician. You've been at it again, building a very impressive spreadsheet. You're going to be looking at the numbers on someone who's renting versus someone who wants to buy a property.
So as you say, Andy, it's been a lot of calculations. It seems to be a new thing we're doing that people like, so we are going to be doing more of it. So that real deep analysis. And this is how we're going to answer that question about buying or renting. So is it better to buy a home or keep renting? It's a massive decision, and honestly the answer is rarely simple. It depends on so many factors. So your personal finances, for example, market conditions, and even how long you plan to live in a property. But I'm not going to just talk about the theoretical. I'm going to actually crunch the numbers, and that's going to be numbers including stamp duty, solicitor fees, house price growth, investment returns to see when renting is better than buying and vice versa. And I'm also going to be tackling a few conventional wisdoms along the way and revealing some insight about investing in property. Now, one thing to point out is that I'm going to be looking at the purely financial aspect of buying a house versus renting. Buying a home is exactly that. You're buying a home, and there are lots of reasons why you would buy a property, but people often ask about just the financial part and whether now is a good time to buy their first home. Now, I am going to be bringing up a calculator on screen, which we will give you access to. We'll put a link in the notes of this video in due course so you can download a copy yourself and put your own scenarios into it. On screen, you can see the calculator we've built, and we'll run through some real-world scenarios using historically accurate data for the UK to see exactly when renting is actually better than buying over certain time frames, and crucially when buying becomes the clear winner. The calculator looks at a comprehensive range of variables that influence your decision and the outcome. So let me quickly run through them because each one plays an important role. So first up, you've got property value, which is pretty self-explanatory. The deposit amount is the amount you're going to be putting down when you try and buy a property. The mortgage interest rate and term, these will dictate your monthly mortgage cost and will depend upon the amount you want to borrow as well as your deposit, of course. First time buyer status. Now this is important because it impacts the amount of stamp duty that you pay. First time buyers can pay less stamp duty in certain situations. Then we've got upfront buying costs, which are things like solicitors' fees, mortgage arrangement fees and survey costs. And then we've got the ongoing cost of ownership, so things like annual maintenance costs, which are often overlooked. So that's things like repairs or you improving the property, something that you won't tend to do if you are renting. Then you've got the buildings insurance, so you'll need to have buildings insurance if you own a property, which you won't do if you are renting typically. Then there's the market dynamics that we include, so the annual house price increase, the annual rent increase, so if you're a renter, how much that's going to go up over the long term. And then finally we've got the amount of interest that you can get, or the investment return you can get on money that you put away. So this is like the opportunity cost if you decide to keep renting rather than buying. And the comparison period, as I've already mentioned, that we can change at will. So of course we could put any data in this calculator and it will spit out a result at the bottom. So what it does, it will go through, analyze all that data. It will look at the analysis of buying, telling you the change in your net worth versus if you are renting. And then it will give you a difference at the end. If that number's negative at the bottom, then renting's better. If it's positive, then buying is better. So what we've done here is put in some averages for the values based on our research. So the property value for the first time buyer is going to be £270,000. We're going to change that. In this scenario, I'm going with somebody who's got no deposit. So they're taking out a 100% mortgage. Typically, you're going to get 5.75% or somewhere near that. It could be a bit lower or a bit more on your mortgage rate. We're going to look at a mortgage term of 25 years. And solicitor fees, we're going to, throughout this analysis, we're going to use £1,500, mortgage arrangement fees of £1,000, survey costs of £600. Interestingly, annual maintenance costs, we put 2.8%, and that's of the initial property value. And that is roughly in line with what Checkatrade have found in their research that people spend on their property, 2.8% of the value every year in terms of maintenance. Building insurance is roughly around £300. Now, it goes without saying that if you rent and you could buy property where the mortgage is lower than your rental cost, then you are almost inevitably always going to be better off buying a property than renting it, assuming you can get the mortgage. So we're not going to look at that scenario. We're going to look at the scenario which some people will find more typical, where maybe their rent is less than the potential mortgage of the house they're going to buy. Now, we are using a 5% interest rate on any potential savings that you can put away. And I'm going to change that annual rent increase to 3% to match inflation. And I'm going to do an initial comparison period of 2 years. So this scenario, somebody who's a typical first-time buyer, and if they are only paying £900 a month in rent, they go and buy a property with the details I've said, £270,000 with no deposit. They may be looking at a mortgage of £1,698.59. It means that they could potentially, if they stayed renting, have nearly £800 left over. So their rent is lower by £800 than their monthly mortgage amount. So they have the ability to put that money into savings and that compound over time. So this is what the analysis looks at. Now, crucially, this scenario I'm also going to create is an environment like we've got now with the mortgage rates, but with a fairly stagnant property market. So the annual house price growth we're going to say is that house prices are going to just be flat. They're not going to go up. And we're only looking at a period of initially, let's say 2 years here. If we look at the 2-year time frame, then what will happen is that the buyer will be worse off over a 2-year period once they've bought, to the tune of nearly £6,500. Over 5 years, what will happen is that that will increase slightly to £7,500. And this is because they are not benefiting from an increase in equity in their home because they've got a 100% mortgage. Now let's see what happens if we have a fairly low growth rate on property of about 1%. After 2 years in that scenario with a 1% growth rate on house prices, they would still be marginally better off had they stayed renting. But very quickly you will see, if we get to just 4 years, that number rapidly starts to increase into the positive where buying makes sense. And if we continue increasing that to 5 years, you can see the numbers go up to £6,000 into positive. By year 10, what will happen is they will be £30,000 better off. And this is really because the equity in their home is growing as house prices are growing. And if I increase that house price rate to something like 3%, which is a bit of a long-term average, you can see after 10 years already their equity has ramped up and they're going to be nearly £100,000 better off than somebody who'd stayed renting. Now, one of the big things is that it depends very much on the difference between your monthly rent as well. So if the monthly rent was pushed up towards what is a long-term average in the UK of 1,350, so 1,350, then what you see is they are so far worse off if they stayed renting than if they bought, because the differential is only a few £100s a month between their rent and the mortgage. So by buying a house, they're only about £350 worse off in terms of money that they can put away. Yes, if you rent, they can put that money away into savings, but their equity in their property is growing at a faster rate. So what I want to do now is just quickly knock that back to roughly £900 a month. So with that rent change, this is more in line with where I found myself when I bought my first house. And the numbers were fairly similar to this. And so in the long run, I ended up being able to be better off when I bought my first home. But I bought my first home just before the financial crisis. When I say just before, I'm talking about 2 or 3 months. See what happens when you get a little bit of negative equity. So we're not talking about much. We're talking about house prices falling 0.5% a year for a period of time. Now I'm going to knock this comparison period down to, say, 2 years. Now, what you see happens is, I'm just saying here that property prices are going to fall 0.5% for 2 years. And at the end of that 2-year period, we're looking at what's our net worth done? How has it changed? You can already see then that by buying at the wrong time, you were £9,000 worse off. And that's a scenario that many people found themselves in. And interestingly, there were places as recent as 2023 in the UK where the house price hadn't risen back above the level where it was before the financial crisis. It just shows you, if you're unlucky and get the timing wrong, then what will happen is that you could find yourself in negative equity. But then this is what happened to me. So let's just say you stayed somewhere for 14 years. Even in that scenario where house prices, and I've said they've continued to fall at 0.5% for 14 years in a row, which is possible. It has happened in the past where we've had extended periods, maybe not quite that long, but we've had significant falls. By having a repayment mortgage, you are still going to be net positive after a period of time to the tune of £7,000, even if house prices were slowly falling for that 14-year period. I've used 14 years because that's the period I lived in my first house. But obviously house prices don't always do that. So if we just put that back to even zero, then what you see, you are significantly better off. But then if we go back to putting that at about 2-3%, then what we see is very quickly you get significant amounts of equity in your home. So that is one danger of buying a property you have to be mindful of. You could end up in negative equity because of timing. But if you live somewhere long enough, then if the prices rise, then you should get out of negative equity. But even if they don't and you've got a repayment mortgage, then you still could get out of negative equity and you could still be way better off than had you been renting. So I'm going to set up another scenario now. This is somebody who's got a 10% deposit. So they get a better rate on their mortgage. So if you look at the best mortgage rates in the market, they will get a rate of about 4.38%. We'll put a link in the notes to the best mortgage rate out there. And I'm going to put this back to a 2-year time frame we're looking at. And even keeping a typical 3% rise in house prices, don't forget your rent's going up by 3% a year. Even if you could put £400 a month into savings, paying 5% interest, which is a good rate that you could get now, you would still be better off by buying after 2 years. And if you extend that time frame to, say, 10 years, you can see how quickly your wealth starts to grow. £136,000 better off by buying under this scenario. But let me put in a scenario where property prices start to fall. You're unlucky like me and you buy just as the market starts to turn. Every time I buy a house, the market does seem to fall. It just seems to be slight bad luck. Now, assuming we're going to look at 2 years again, the first 2 years, because that's when people's mortgages come up and they often think about a 2-year time frame. Under that scenario, if properties have fallen 1% for 2 years in a row, you will be marginally worse off by about £5,500 if you buy a house. You'd be better off just staying renting based on the assumptions that we've made. But then look how quickly the situation resolves itself. After 4 years, you've already dropped down. You're only £3,000 worse off. By the time you get to 10 years, this is still assuming that house prices are falling 1% a year. You very quickly get into positive territory by buying a property being better off to the tune of nearly £18,000. And that's because you are clearing more of your mortgage. You've got a bigger chunk of equity. You started with a bigger chunk with that deposit, and it increases as you pay it down. You get out of negative equity even quicker. So then if we put this back to a long-term average, we're talking about the annual house price rise to 3%, then you can see it's very significant that when you buy a house and you've got a significant deposit, that your wealth does grow more quickly if you buy. But the takeaway from this point is that that's why I would always buy a property with a repayment mortgage, which is really the only option you pretty much have these days, although there are now more interest-only mortgages becoming available. Back when I bought my first property at the financial crisis, you could get interest-only mortgages, but I bought with a repayment, despite seemingly everyone else doing interest-only, because I was mindful of the fact that if you have a repayment mortgage and you have a decent enough deposit, they protect you from negative equity and they keep your options open, so if you need to move, you are able to in the future. So people looking at this might think, well, buying properties a great investment, that's why it does better than maybe saving. And we're going to change the savings rate in a minute for money that you have in cash to see what happens in that particular scenario. But the reason why having money in property can suddenly accelerate your wealth is not because of the property itself necessarily. It's really down to the fact that you are using something called leverage. So the UK economy is set up and you're able to borrow money at scale and invest in property. You can't invest in other things, but you can borrow money at scale, multiples of 6 times your salary, and buy a property. So that's why when property prices go up, even just a small amount, when I've been playing with these calculators, suddenly your wealth accelerates, because it's the percentage on the total property value that is working on. And you, in fact, even if you only got a small amount of equity, you are using leverage to amplify your returns. But it's also why when prices fall, that you can see your wealth decline significantly, and renting ends up being the better option. So if you learn one thing from this video, when people talk about property as a great investment, it's leverage that's doing most of the lifting, that's making you more wealthy. Now, I want to do a third scenario, and this is going to be somebody who is perhaps living in London, who has quite a hefty deposit. So it's somebody who's got a bit of money. If I change the numbers and put the house price to £450,000, and let's say they do have a 10% deposit, I'm going to change the annual house price growth to 1%. That reflects what we've seen in recent history. That's something I want to come back onto later. And I'm going to put the rent a little bit higher towards that national average of 1350. Again, we could put whatever we want into this, but I'm just going to use some average numbers. Yes, that might be a bit low for a rental property in London, but it just gives you a scenario. And I'm going to have the rent increase by 2% a year, and I'm going to have that 5% in savings. Then what you see if we move this to 2 years is that someone in London after 2 years will be better off renting, because that short period of time they've got a higher mortgage rate. You see the mortgage leapt to £2,200 versus their existing rent. So the person who's able to save at 5% is increasing their wealth over that period of time, and they have benefited from a significant amount of house price increases, only at 1%, which has been in line with what we've seen recently in London. The other thing to bear in mind is they've had to pay more in terms of stamp duty when they bought the property because of the property value. Now look what happens when you look over a 5-year time frame. So put that in, and then suddenly buying looks much more attractive. It's almost £14,000 they're better off after a 5-year period. But notice how much their wealth increases in the next 5 years to the 10-year time frame. Suddenly it's gone to £51,000. That's a massive jump, and it's because they are now benefiting from that combination of reducing their mortgage, so they've got more equity, but also that compounding effect on that significant house price. And so it does mean that that's why we see patterns where people might buy in somewhere like London and then start to move further out. We saw a lot of that obviously in the pandemic for various reasons, but we've seen the continued pattern of that where people use that geo arbitrage, so they might grow their wealth in one area and then move elsewhere to release some of that equity. But of course, it all depends on what property prices will do, because again, in the opposite way, if property prices start to fall, maybe you've bought a flat that isn't particularly desirable and you can't sell it for so much. And I'm just saying, over that period, house prices fall by 1% a year, then suddenly you are on a significant loss compared to renting. So yes, you could just stay in the property and hope that prices increase or pay off your mortgage over the long term before you sell, but you would be worse off versus renting. Now, I want to close this off because I could be here all day showing different scenarios, but I want to show you a scenario where somebody definitely would be better off renting over the long term. And I'm going to call this person just a wealthy investor. I'm going to change the deposit to 100,000. So they've got a lump sum that they could choose to buy a property with. I put a million in there, 100,000 that I could buy a property with, or they could instead decide to invest that money and carry on renting. And the difference between their mortgage and the rent they're paying now, which I'm going to assume is lower, so I'm going to put that rent down to £900 a month, that they could as well invest that. And we're going to assume a better investment return. We assume savings, but let's assume they get 8% a year. Maybe they're taking a bit more risk investing in something that's more diversified, including equities. And I'm even going to knock up the house price growth to 3%. What you find happens is they will be, over a 10-year time frame, £56,000 better off if they had stayed renting. And if we extend that to 20 years, you can see the numbers grow even more. And so suddenly they would have been more than £250,000 better off staying renting. So why is that? And again, it's because they are not using leverage as much, because they've got a much bigger deposit. And they're also getting a better rate of return because they're investing over the long term. This person has decided, I don't need my money in 5 years. I'm going to invest for the long term, just rent and invest my money. And then they could decide at the end to buy a property if they wanted. Of course, there are some assumptions in here that the rent is only £900 a month. Would somebody who's got £100,000 really live somewhere where they would only pay £900 if they could afford more? I'm assuming the annual rate of increase is only 2% on rental. So yes, there's lots of assumptions that we can play with, but there are scenarios, that's the message, where you could for the long term be better off if you rented. So is that a realistic scenario? Maybe not. Some people may be lucky enough to be able to live with family members, or there may be a family member who's a landlord who gives them a pretty low rental property to live in for an extended period of time. But it just goes to show that there are scenarios where you can be better off if you rent. But the most likely thing is that you will probably be better off if you buy, if house prices continue to go up. But the point is, there are scenarios where you can argue for either way. Typically, buying will increase your wealth over time because of that thing called leverage. Now, it does raise the question about the house price growth. That is crucial to a lot of this. Now, are you going to be unlucky? Is now a good time to buy, for example? That is a difficult question, but one thing I wanted to draw people's attention to is a bit of research by Rathbones. I'll put a link to the research in the notes of this video, but Rathbones have stated that the golden age of UK property investment is likely to be over for various reasons that I'm not going to go into, including reasons of government policy. But there is a suggestion that I just want to pull out, that the rise in house prices over the recent years, so from 2016, has only been 1.3% a year in London, so less than you probably would have thought, which is why I used the example earlier. I was only putting a relatively low growth rate. So if we can't guarantee that house prices are going to go up, then that means it could massively impact those wealth calculations. But it does also reiterate one of the big things I always try and tell people is not to rely on property just to grow your wealth for a pension, for example. So a home is a home, it's where you would want to live, and banking on your property to increase your wealth over time, yes, it may happen, but it does limit your options, because you will have to, for example, downsize or borrow money out of your property, again, via things like equity release, but it does limit your options. So something to bear in mind, you're probably never going to time the market. You can't necessarily think you're going to get the rates that people have done in the past. But hopefully we've shed some light on the important things to think about when you're trying to buy a property and whether you're going to get on the property ladder.
Okay, let's move on to the next piece of the podcast then, Damien. You're going to be talking about how to make money from credit cards.
So there are two main ways you can make money from credit cards. Now, the first one I'm going to talk about are cashback credit cards. Now, most people will know what these are. You use the credit card, you spend on it, and then you'll get a cashback reward, normally a percentage of the purchase price. So there's an article on screen where we analyse the best cashback credit cards in the UK. It goes without saying, I'll put a link in the notes to these, but the standout performers are the best credit cards really for cashback include American Express credit cards. There's more than one type, but the one I'm going to focus on in this analysis is the American Express Cashback Everyday credit card. Now, it doesn't have an annual fee and it will pay 0.5% on any spending up to £10,000, and beyond that get 1% on any spending. Of course, there are new member offers all the time, but I'm going to base it on the standard rates that they pay. Now, one thing I would say about cashback credit cards is they are great as long as you have your credit under control. So you clear your balance every month, you budget, you keep to that budget, and you don't leave money on the credit card, otherwise you'll pay interest. So when you're on top of your finances, cashback credit cards can be a way of you gaining some additional money. For example, last year I made nearly £400 on my cashback credit card. But I am very particular about how I manage my finances and that I do clear my credit card in full each month. But there is another way you can make money from credit cards, and it's called Stoozing. Now on screen you can see full information about how Stoozing works. There's an article on the Money to the Masses website which I'll put a link to in the notes. And Stoozing very simply works by you taking out a 0% purchase credit card, and then what you do is you put all your daily spending on that credit card. So let's say you get paid, rather than taking money from your current account and using that for your shopping, you actually use your 0% purchase credit card, and that will have, say, a 0% purchase period of 25 months, which is one of the best you can get at the moment. Then what you do with that credit card is you make sure you pay the minimum amount off that credit card each month. So the balance is building over time, but you're not being charged interest on it. Then any spare money that you have in your current account, so that's the account that you're not using, so it's the money from your wages, you move that into a high interest savings account. And then when you get to the end of that 0% purchase period, so that 25 months, for example, you then clear the balance on that credit card with the amount of money that you have in your savings account, and you pocket the difference, which will be the interest. That is Stoozing. Now, jumping across to the best 0% purchase credit cards, which we compare on Money to the Masses. Again, I'll put a link in the notes to this. You can see that there is a 25-month interest-free period card. This one is from TSB. So you can see that these cards do exist. So it's possible to make money from Stoozing, but how much money can you make, and does it beat cashback credit cards? So we crunched the numbers to see whether using a cashback credit card or Stoozing works out best. To complete the analysis, we compared the Amex credit card, so the one that offered 0.5% cashback on the first £10,000 you spend every year, and then 1% cashback thereafter, versus somebody who used the 25-month 0% purchase credit card offer to Stooz, and they put the money from their current account they weren't using into a savings account, paying 4% interest. So these are all realistic assumptions. You can see on screen a grid that we've compared what would happen based upon your monthly spending from £500 a month to £5,000 a month. And it depends as well on the credit card limit you were given when you took out the 0% purchase credit card, because not everybody will get the same. On the chart, you can see there's green numbers and red numbers. Green numbers mean that you would have been better off just using a cashback credit card rather than using the slightly more convoluted Stoozing method. If they're red, it means Stoozing beat using a cashback credit card. And what you find is if you want Stoozing to work successfully, you need to have secured a credit limit of £5,000 on that 0% purchase credit card, because it's from that point onwards really that you start to make more money from Stoozing than you do from simply using a cashback credit card. But of course there then becomes a limit how much you can earn with Stoozing once you max out your credit card. So for example, if you have a £5,000 limit on your purchase credit card and you spend £500 a month, then you would make over that course of that 25 months more money by Stoozing, you make £353. If you spent £1,000 a month, then you would make £398 from Stoozing. £1,500 a month spending, you would make £412 Stoozing. It's once you get to £2,000 that you make £419 from Stoozing. But as you go above that amount of monthly spending, it's because you very quickly max out your credit card, then you would be better off using a cashback credit card that you cleared. Of course, the assumption is you're going to just Stooz or use a cashback credit card. The other option that people sometimes do is when they get to the end of the 0% purchase period, they then take out a 0% balance transfer credit card, and you can get some that don't charge a fee for transferring across. Now, sometimes the balance that you can have on it is quite limited, but it is technically possible, and they try and extend the period on which they are at 0% and try and make a bit more money. But that is probably pushing it a little bit too far in my view. But would I use Stoozing? Well, the answer is no, I haven't, and I personally wouldn't do. But there are plenty of people, if you look at enough of the Reddit forums and things like that out there, that do use Stoozing to make free money, and they will also be the people who probably use bank switching offers and play the game on that to get free money. But there are things you need to be mindful of, which is the reasons why I wouldn't suggest people necessarily do Stoozing. Yes, you can make some money, but the issue that you've got is that there are cons, like you have to take out a new credit card. It will make a hard credit check on your report. If you take out a number of credit cards, if you're trying to really play the game, then it could negatively impact your chances of getting credit for something like a mortgage when you do actually want to borrow money for a valid reason. Also, if you suddenly want to clear the money on the credit card because you decide you don't want to do Stoozing anymore and you've locked it in a fixed rate savings account, for example, to try and get a better rate of return, then you will lose money on the withdrawal. Normally there's a financial penalty. So Stoozing does have its risks. And for me, I wouldn't personally do it because of the impact on your credit rating, but that's not to say that people aren't interested in what it is and why we are seeing more people starting to talk about it, particularly when we've got interest rates so elevated.
Okay, so let's move on to the final piece of the podcast then. And it's a particular scam I wanted to bring to the podcast listeners because it is this time of year when people are booking holidays. Now, The Guardian have reported that Booking.com have had issues. Now, it's important to recognise that Booking.com themselves haven't been infiltrated by scammers. It is actually the people that list their properties on Booking.com. So what's been reported is certain hotels have actually been targeted by scammers in a phishing scam, and the scammers have somehow got the login details for those hotels. Now, once they've got the login details, they actually get the details of all the people that have booked the accommodation with them. And so once they've got access to all these customer details, they can send out messages to official customers with details about their specific bookings, saying perhaps that there's been a problem with their payment, or they might say that their credit card has been declined, or that they just need to verify their payment details in order to confirm the booking. Now, what is often happening is these messages do create a sense of urgency. Often they'll say things like, you need to do this in order to ensure that we keep your reservation, or we'll have to release your reservation if you don't confirm these details. And it's a very clever scam because they know the exact details of the holiday, they know the amount, the payment amounts. And where the scam actually takes place is they will then place a link within that messaging service asking people to confirm their payment details. And that's obviously a fake link. It may look like Booking.com, but it'll be a fake link where the scammer will ultimately be able to take the payment details and take money from the customer's account. Now, again, I will make the point that this isn't Booking.com who's having the issue. It is the hotels themselves that are having the issue. So what you need to look out for if you do have an account with Booking.com is be wary of any messages that you're getting now. If there's any messages that you're receiving that create any sort of sense of panic or ask you to do things by a certain date, just make sure that that is officially coming from Booking.com, because scammers will often use threats like cancelling your booking to rush you into making a decision. Also look out for any instances where the grammar is poor and the spelling mistakes. That's often a real telltale sign. And just be suspicious of any sudden request to make full payment up front, especially if you weren't aware of that when you initially booked it. Probably most importantly is just be wary of any links that you click within messaging services, even if it looks like it is the official booking.com service that you are talking to on that messaging service. The best thing to do is contact booking.com separately. So close the messaging down, close everything down that you've got opened, and search for their details within a completely separate link, maybe a separate device as well, or even better, find the details of the company that you've actually booked through, whether it's a hotel, and speak to them separately. Give them a call, find out the details, and you should be able to resolve any issues. And just finally on this, you may not have had any problems. You may have a booking.com account and everything's fine. You can protect yourself against future problems by enabling the two-factor authentication inside the app itself. So you are able to do that. We're used to doing these things now in everyday life. Maybe it's our bank accounts, maybe it's our email. So make sure that you do that on booking.com as well. And Damien, I'll bring you in here because we're talking about this now on the podcast. The Guardian's reported, in fact, most major news networks have recorded this. It does seem to be a bit of a problem. You also had a bit of an issue with your account.
Yeah, so it was funny that you mentioned this, and the article The Guardian wrote about what happened with booking.com, but it was exactly the same company with which I had a problem, my wife had a problem. So that what the scenario is slightly different, but there were some similarities with the messaging within the app itself. And if you log on the website, you could see messaging. So the first thing my wife knew is somebody had actually paid £150 for some accommodation via booking.com. She got a notification from her credit card. So it happened that instant she saw it, went into booking.com to look, and she could see that a booking had been placed at a hotel in the UK near a UK airport. But there was a lot of messaging going back and forth between the hotel and the person, and they were apparently responding. So it looked like there's a communication between a third party and this hotel within my wife's booking.com account. And there were links going back and forth on that as well. So there is a bit of a similarity. Obviously, she didn't click on those links, so I don't know whether that was anything to do with phishing, but you're always going to be wary. But what was slightly different is because payment was taken. So I have no idea how this scam was working or what they were trying to do. Obviously, my wife contacted the credit card company and booking.com. Booking.com did refund the money relatively quickly. It did take quite a bit of time to actually resolve the situation. But when she went into the account, what booking.com will do is send you a code. So there's not a password on the web portal. There'll be a code they send you to your email address that you then put in to gain access. So it's not two-factor authentication. It's something sort of similar. It's just not a password. So you get a code. They hadn't had that code. So the person hadn't compromised my wife's email. We knew that. We checked it. We reset everything just to make sure. And she has two-factor authentication on her email. So maybe they, like you mentioned, could have got through the hotel. I don't really know how that happened. But one other tip that I want to add to yours, Andy, there was put two-factor authentication on, which we did on the booking.com website. But you can also click to clear any existing sessions on booking.com. So if somebody have got access to her account, my wife's account that is, and started writing messages, then by doing that, you actually would have kicked them out. But interestingly, having seen the Guardian's report, and then when we were looking at the messages and what's gone on, I think what was most likely to have occurred is they didn't actually compromise her account because there was no password requests or anything like that. But it's more likely it was a compromise somewhere else. And what was also odd is they used a payment on a credit card that wasn't saved in her booking.com profile. So that's not to say she may have not used it with them before, she couldn't recall. But the message is there's quite a few things like this going on. It's not just about giving booking.com a kick in, but let's be quite frank, this is a personal experience of what's happened. And the Guardian story shows there are other things going on. But in the last week, oddly, two other people, so one of my siblings and one of my best friends, have also had scams occur where people have taken money from their accounts, not on holiday sites, but on other things. Like one of them was Roblox. If you don't know what Roblox are, then ask your young child. It's the currency they use in a particular computer game. So I don't know what's happened out there. It feels like there's been some major hacking going on somewhere, that people are gaining access to accounts and credit cards and things like that. So just be mindful. Do be sure to check your credit card accounts regularly. The person I was talking about, my sibling, hadn't realised that a previous transaction had gone through during the month because they hadn't checked their credit card statement before the one that they actually got notified about that was fraudulent. So do make sure you regularly check your credit card statements. And even if you don't use a budgeting app to budget, the one thing I would say about using a budgeting app is that they are good at giving you an overview of transactions that go through various accounts that you may have, or you may have multiple credit cards as well.
And so, yeah, that's a really good point. And that's reminding me, Damien, I use a cashback credit card. We talked about that earlier on in the podcast. And I don't really check that as much as I check my actual bank account. I just kind of pay the balance off each month. I need to be better at that. I'm going to check it line by line. I'll do that straight after the podcast. I think that's it, isn't it, Damien? We're pretty much done for this week.
So, yeah, before we go this week, one thing I do want to mention, next week, I'm going to be revealing something that I think everybody's going to love. It's a new direction for Money to the Masses. So do listen out for that. As ever, do follow us on all our socials, Instagram, TikTok, Threads, you name it, YouTube, Facebook. Do make sure you like and you subscribe to all of the channels. Our newsletter, moneytothemases.com/weekly-newsletter. That comes out 10 a.m. every Sunday with all the major stories that will impact your finances. So do make sure that you sign up for that as well. And I think, Andy, all that's left is for me to say until next time.
Until next time.